Welcome to the Coin Bureau Weekly News Roundup. Here are the top stories in crypto this week. Crypto market rally. The total crypto market cap explodes past $1 trillion as BTC pumps by more than 30% in response to the de facto bank bailouts. Is this the beginning of a new bull market? Ethereum upgrade incoming. Developers reveal the date for Shanghai, while SEC Chairman Gary Gensler reiterates that proof-of-stake cryptocurrencies are securities. How could this impact ETH's price? US Exodus escalates. Coinbase plans on opening a new exchange overseas due to regulatory scrutiny, but not all foreign jurisdictions are crypto-friendly. What does this mean for the crypto industry? The Fed versus the markets. Investors insist the Fed must decide in the coming days between saving the banking sector and fighting inflation. Here's why this decision may not be on the table yet. And of course, we'll get the unique perspective of the one and only Mr. Benjamin Cowen. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy. None of what follows is financial advice. And here is the news. Last week, the crypto market experienced an epic rally, with Bitcoin taking the lead, posting a more than 30% gain over 7 days. The pump was caused by a combination of factors, including a massive short squeeze, a $1 billion buy by Binance, and the Fed's response to the banking crisis. Based on data from the block, over $300 million of leveraged BTC short positions were liquidated over the last week. This translates to over $300 million of buying pressure for BTC. Now, this is quite large during a bear market when it doesn't take nearly as much money to move prices up or down. It is therefore safe to assume that Binance's conversion of $1 billion of BUSD into BTC, ETH, BNB, and other unspecified cryptocurrencies contributed to the recent rally. Binance CEO Changpeng Zhao announced the conversion on Twitter early last week, citing stablecoin concerns. Now, it's often said that narrative follows price. In other words, the explanation for the pump comes after the pump has already begun. In this case, it appears that the narrative which followed the price action was that cryptocurrency, especially Bitcoin, is a hedge against the traditional financial system. This narrative took hold after the Fed and its allies effectively bailed out the depositors of Silicon Valley Bank, or SVB, whose collapse we covered in a recent video. As part of this bailout, the Fed had to increase its balance sheet by $300 billion. Put simply, the Fed printed $300 billion new dollars. Given that Bitcoin was built in response to the bank bailouts of 2008, BTC's price went parabolic in response to the SVB bailout. BTC is also considered to be sensitive to changes in money supply. As such, many have argued that the increase in the size of the Fed's balance sheet is the key driver of the rally. The caveat is that not much else has changed in terms of fundamentals. On the macro side, interest rates are still high, meaning that new and existing money is being invested into safer assets offering much higher rates of, interest. On the crypto side, meanwhile, the US government's crackdown on the industry is in its first innings. For reference, the crackdown began in January. So far, all the pro-crypto banks have been shut down. There's speculation that stablecoin issuers are next. Binance's selling of BUSD underscores this possibility. Until these two fundamental factors have been addressed, it's hard to say for certain that the bull market is back. However, this doesn't mean that crypto couldn't go higher in the short to medium term. We could also see other cryptos decouple from the rest of the market like BTC did. ETH could be next. That's because Ethereum's Shanghai upgrade has officially been scheduled for Wednesday, the 12th of April. Shanghai is significant because it will allow validators to withdraw their staked ETH and any ETH staking rewards they've accumulated. Shanghai could also make ETH more appealing to institutional investors. This is because institutional investors love yield more than anything else. The prospect of being able to earn a yield on what is effectively the next network for payments is an appealing one. It's believed that many institutions were hesitant to stake ETH because it wasn't possible to unstake. This will change with Shanghai, and, assuming the initial wave of unstaking goes smoothly, we could see millions, if not billions of dollars flow into ETH in the days and weeks that follow. It's believed that the buying pressure from incoming ETH stakers will offset the selling by the validators unstaking ETH. Well, this ultimately depends on crypto market conditions, which could be upset by SEC Chairman Gary Gensler's ongoing crusade against the industry. Besides the SEC's scrutiny of stablecoins and staking services offered by exchanges, the agency has also been scrutinizing proof-of-stake cryptos. Gary infamously insinuated that proof-of-stake cryptocurrencies could be securities in September last year, on the same day as Ethereum's transition from proof-of-work to proof-of-stake. Fortunately, or unfortunately, Gary's concerning comment was quickly forgotten. That was until last week, when Gary reiterated that proof-of-stake cryptocurrencies could be securities. He said this as a follow-up to a recent interview where he'd specified that every cryptocurrency except Bitcoin is a security. This has led to speculation that the SEC will target ETH next. If you've been keeping up with our coverage of the SEC's lawsuit against Ripple, you'll know that it appears the agency is trying to set a precedent to go after other altcoins. You'll also know that a former SEC director famously said back in 2018 that ETH wasn't a security because it was, quote, sufficiently decentralized. Now, in theory, this means that ETH is safe from the SEC. In practice, however, this could also change after Shanghai. That's because ETH is still technically a proof-of-work asset. Once unstaking is allowed, ETH will officially become a proof-of-stake asset, and this could change its status in the eyes of the SEC. This begs the question of whether the SEC really would be crazy enough to try and crack down on ETH after the Shanghai upgrade. The answer is anyone's guess, especially with Gary Gensler at the helm. But it does seem that the SEC is intent on cracking down on a proof-of-stake cryptocurrency of some kind. It may not be ETH. If it is ETH, then the SEC will eventually lose. This is because there is no identifiable third party you can point to as driving the expectation of profit from investing in ETH. Even so, ETH's price would suffer until the suit was resolved. At least it would be a buy-the-dip opportunity for everyone outside the United States. That's because it's likely that ETH could be delisted from all exchanges in the US, just like XRP was after the SEC sued Ripple. I would hope that the crypto industry would put up more of a fight in the case of ETH, but it seems the industry is already struggling to survive in the land of the free. According to Bloomberg, Coinbase is considering setting up a separate set of operations overseas. This is reportedly due to the intense regulatory scrutiny of the crypto industry in the US. What's interesting is that the establishment of an offshore exchange could put Coinbase in direct competition with Binance. To put things into perspective, Binance consistently has 10 times more trading volume than Coinbase, which is publicly listed and apparently has more than 100 million users. Binance's massively larger volume is fundamentally due to Coinbase's inability to provide the same suite of services, thanks to regulations in the United States. According to The Block, Coinbase's offshore exchange will offer derivatives, that is, futures and leveraged trading. Not surprisingly, derivatives trading tends to generate a lot more trading volume than spot trading. That might have something to do with degens being somewhat overrepresented in crypto. The fact that Coinbase is considering setting up a second shop overseas further underscores just how bad the US crypto crackdown is getting. This crackdown is simultaneously creating huge opportunities for countries and regions that are open to crypto, such as the UK, the UAE, and the EU. It's easy to forget that the world is bigger than the United States, but it's also easy to forget just how much influence the US can have on global regulations. If you watched our video about the Financial Stability Board, or FSB, you'll know that it will be rolling out global crypto regulations starting this summer. Although the pro-crypto regulations proposed in the EU and the UK suggest that not everywhere will be on board, there are early warning signs that these regulations could change for the worse before they become law, and existing pro-crypto jurisdictions could be forced to fall in line as well. For example, in February, the EU suddenly announced that it would be rushing through regulations for banks with exposure to the crypto industry. This is no coincidence when you consider that US regulators have been scrutinizing the exposure that banks there have had to the crypto industry since January. Another example happened just last week in the UK. Binance had to suspend deposits and withdrawals in GBP after PaySafe, its payments partner, cut ties with the exchange. In response to an email from the block, a PaySafe spokesperson said it was because of the challenging regulatory environment in the UK. To be fair, Binance has been facing regulatory scrutiny in the UK for quite some time. The thing is that it's not the only exchange that's been affected by this regulatory scrutiny, and it won't be the last. Now, as a Brit, I can tell you that I'm disappointed that the old country isn't being as pro-crypto as it claims to be. The silver lining to this situation is that there are still many places that are open to crypto which are not beholden to the United States. Hong Kong is one that comes to mind. The territory will be allowing institutions to invest in crypto sometime in the summer. While this is still months away, it is nonetheless a shining light at the end of the cave in which the crypto bear market has been slumbering. In other words, it could help to resolve the regulatory snarl-up weighing down the crypto market, and it may coincide with a resolution of the main macro factor doing the same. Yes, I am of course referring to the ever-rising interest rates around the world. Higher interest rates make it harder to borrow and make existing debts more expensive. The practical effect is that trillions of dollars flow out of assets either because debts need to be paid or because companies are less profitable. Funnily enough, this flow out of assets has affected the banks, which have been investing deposits from customers into assets labelled as low risk, primarily government debt. Lo and behold, the rapid rise in interest rates caused these assets to crash, resulting in hundreds of billions of unrealised losses. Now, these unrealised losses are fine so long as all the bank's customers don't come rushing to reclaim their cash for whatever reason. As you might have guessed, that's exactly what happened to all the banks that have gone under, and it is the key cause of what may become a bigger banking crisis. This precarious situation is why investors are expecting the Federal Reserve and other central banks to start cutting interest rates ASAP. That's because cutting interest rates means all those unrealised losses that banks have will disappear, as will all the other skeletons in the closet of the global financial system. The problem is that inflation in the United States and elsewhere is still very high. Lowering interest rates right now would cause inflation to come roaring back. In some cases, this resurgence in inflation could morph into hyperinflation. Sure, all assets would moon in value, but not in actual real terms. That's why all eyes are on the Fed's upcoming interest rate announcement, which will be released this Wednesday. Investors are currently torn on whether the Fed will stop raising rates or squeeze in another 0.25% increase to maintain credibility. 25 bips is what Papa Powell promised, after all. If the European Central Bank's recent rate hike decision is anything to go by, the Fed will stick to its guns and push interest rates up to the psychologically appealing level of 5%. How long the Fed holds rates at 5% is a different question entirely, which will conveniently be answered by its summary of economic projections. So, make no mistake, the Fed's summary of economic projections will be the most important part of its upcoming announcement. If Fed officials are determined to keep interest rates high despite the recent banking crisis, the markets will crash hard. If they see rate cuts coming soon, however, the markets will rally a lot. Naturally, investors are expecting to see rate cuts on the horizon, but they may be sorely disappointed. That's because the Fed still seems to have some tools under its belt to keep the banking system afloat. The recently introduced Bank Term Funding Program, or BTFP, might just do the trick, at least for now. Without getting too technical, the BTFP lets banks use their safe assets, like US government debt, as collateral to borrow money from the Fed to honour customer withdrawals, despite the unrealised losses. In short, it makes it next to impossible for otherwise solvent banks to go under because of bank runs. This doesn't mean that other badly run banks won't go under, but it does mean that the US banking system will stay intact, even with all the rate hikes. History suggests the Fed will eventually be forced to pivot, but it may not happen just yet. Then again, what do I know? I'm just some crypto bro on YouTube. So, with all that said, let's now get Ben Cowen's thoughts on what he's seeing out there in the cryptoverse.
Hey Guy, thanks for having me. Pleasure to be here as always. Because of the recent rally in Bitcoin dominance, I thought it would be useful to provide an update on it. A few weeks ago, we were sort of talking about the idea of the dominance heading higher as we were going into Bitcoin season, where the general idea is no matter the direction that Bitcoin USD goes, the dominance is likely going to trend higher either way. And what's happened is Bitcoin USD has gone up quite a bit, and the dominance has gone up with it, which is an important aspect to this. Now, the reason why the altcoin market is somewhat at a precarious point is that if we take out here sort of this range high on the Bitcoin dominance, this of course includes stablecoins, but if we go above sort of this like 49% level, then it could be a very similar idea as to what we saw over here. The rally by Bitcoin USD over here sort of broke it above the prior range high, and from that point, the dominance continued to go up even after Bitcoin gave back some of the gains that it had. So I do think it's an important thing to look at. And more importantly, I think, is the development on the dominance excluding stablecoins. Because excluding stablecoins is arguably a more important way to measure the Bitcoin dominance, but it's now over 50%. The dominance of Bitcoin, including stablecoins, is actually right around 51%. And if you look at what the dominance has been doing, excluding stablecoins, it's been putting in higher lows since May of 2021. And really, since January of 2018, the dominance just sort of continues to trend higher. And the reason I think people should be aware of this is that the altcoin season that people really come to love during, a sustained bull market like we had in 2017 and like we had in 2021 typically starts from a higher Bitcoin dominance level. The alt season that everyone remembers back in 2017, 2018 occurred when the dominance was at higher levels. The same thing occurred back over here in 2021. So in order to get to market conditions that can more likely sustain alt seasons that people have seen in the past, ideally you would need to see the dominance of Bitcoin make this rally up to higher levels so that eventually it can fall back off a cliff and lead into those phases that we only see come around in the cryptoverse once every few years or so. But is an important aspect, I think, of the market cycle. So at least in the short term, I think it's important to continue to follow the dominance and see, can the dominance break above this 49% level? And if it can, then it's a sign that it's likely going to continue on rallying up to higher levels, which could sort of set the stage for the finale of the devaluation of altcoins on their Bitcoin pairs, which has been ongoing on many altcoins, not all of them, for over a year now. But anyways, thanks for having me on the channel. Pleasure to be here as always, and I'll see you next time. Bye.
Thank you, Ben. Now, Ben and I will be live with Rob from Digital Asset News this Thursday on Coin Bureau Clips, our second Upstart channel. Kickoff is 9 a.m. Eastern Time, 5 p.m. Gulf Time. I hope you can join us. And that is all for today's Coin Bureau Weekly Crypto Review, so if you enjoyed it, you know what to do. Hit the like button, subscribe button, and bell icon too. If you're looking to help those gains grow, then the Coin Bureau Deals page is where you should go. There are thousands of dollars in bonuses, trading discounts, and products to help you trade like a pro. You can find the link to that resource and many others in the description below. Thank you so much for watching, and I'll see you all in next week's episode.